Ladies and gentlemen, good day, and welcome to the Windlas Biotech Ltd Q3 FY'25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Today on the call, we have Mr. Hitesh Windlas, Managing Director, Ms. Komal Gupta, CEO and CFO. I now hand the conference over to Mr. Hitesh Windlas. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us today for our financial results for quarter and 9 months ended 31st December 2024. We have uploaded the press release and investor presentation on our website as well as on the exchanges, and I hope that everybody must have gotten an opportunity to go through it. Initially, I would like to discuss the outlook and way forward for Windlas Biotech, followed by financial highlights for Q3 and 9 months FY'25 of the company, which will be shared by our CEO and CFO, Ms. Komal Gupta. The Indian pharma market registered a 7% year-on-year growth in Q3 FY'25, primarily driven by price increases as volume growth remained negative. We are pleased to report a resilient performance as we have registered YOY revenue growth of 21% in 9 months and 20% in Q3. This performance is driven by strong momentum in our trade generics and institutional vertical, complemented by consistent contributions from our CDMO and export verticals. The growth of the business development team, expanded customer base, and introduction of new products are driving positive results in generic formulation CDMO vertical, despite negative volume growth and API price reduction, resulting in lower conversion. The trade generics and institutional vertical continues to maintain strong growth trajectory. Our sales force has been broadened across both key and surrounding territories for this vertical, enhancing our market reach. In Jan 2025, the injectables facility received Good Manufacturing Practices GMP certification from the Food Safety and Drugs Administration Authority of Uttarakhand, following an inspection in December 2024, confirming compliance with WHO TRS guidelines in all 5 plants now of the company. Accordingly, large customers have scheduled audits of our injectable facility in Q4 of FY'25. Stability testing, completion of production batches has taken in H1 FY'25 has commenced in Q3 FY'25. In line with our strategic roadmap, Plant 2 extension is also now fully operational. I will now request Ms. Komal Gupta, our CEO and CFO, to discuss the financial performance highlights. Over to you, Komal.
Thank you, Hitesh. Good afternoon, everyone. Our all-time high revenue streak persists into the 8th quarter. For 9 months FY'25, revenue reached rupees 557.2 crores, showcasing 21% YOY growth, and Q3 FY'25 revenue rose by 20% YOY to 195 crores. We are committed to enhancing our capabilities, expanding into new regions, and providing high-quality pharmaceutical products that address the evolving needs of our customers and patients. Our strategic initiatives and operational efficiencies position us for long-term growth and value creation. Our diversified product portfolio, strong customer relationships, and dedicated team, combined with strategic investments, position us for consistent growth in our generic formulation CDMO vertical. This vertical recorded a 15% YOY increase in 9 months FY'25 to 407.9 crore rupees. For Q3 FY'25, this vertical generated rupees 135.7 crore in revenue, witnessing an 8% YOY growth. Our trade generics and institutional vertical continues its growth momentum, indicating strong market acceptance of the company's product offerings. In 9 months FY'25, revenue surged to 126.6 crore rupees, marking a 44% YOY increase. For Q3 FY'25, revenue increased to 49.6 crore, registering 74% growth YOY. Our exports vertical reported revenue of 22.6 crore in 9 months, a 23% increase YOY, with Q3 FY'25 showing a revenue of 9.7 crores, reflecting 19% growth YOY. EBITDA surged by 22% YOY to 68.6 crores, 12.3% margin for 9 months FY'25, and by 21% YOY to 24.6 crores, 12.6% margin for Q3 FY'25. Despite increase in depreciation by 9.7 crores for 9 months FY'25 and 3.6 crores for Q3 FY'25, almost entirely due to injectables facility, PAT stood at 44.7 crores, up 9% for 9 months FY'25 YOY and 15.6 crores, up 3% YOY for Q3 FY'25. That's all from our side. We can now begin the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, wait for a moment while the question queue assembles. The first question is from the line of Sudarshan from JM Financials. Please go ahead.
Thank you for taking my question. Sir, my question is to understand, more strategically on the Schedule M, which is basically being pushed towards the end of the year. This, is expected to be very positive for compliant players like us. So in that context, how do you, one, read this kind of a slight pushback? And are we seeing, more wallet share and more customers coming in, because of this?
I'm sorry, could you please, maybe I can rephrase your question, but the line was not clear. You are asking whether the regulatory scenario remains as strict and whether more customers are coming in because of the regulatory pressure on smaller competitors.
Yes, this is primarily on the Schedule M. So how do you see the Schedule M benefiting us, and is there any impact on the pushback in terms of the deadline?
Yes. I think the Schedule M is definitely a move by the government, which is and by the regulator, which is almost very, very strictly being enforced. Surprise audits are happening across the spectrum. And, we have also received the audits and have passed in flying colors and continue to, I believe even smaller, many companies in, different CMO belts like Baddi and even near Uttarakhand have had these audits and have been closed down. So, definitely customers are looking for more reliable, higher quality, compliant sources of manufacturing. And, we have been saying this almost, we had been anticipating this, we have been saying this since 2021, that this will have an impact on reshaping the industry, and we continue to see this. In fact, the drug controller, the central drug controller, his term has now been extended by another 2 years. So we expect that this push for compliance will continue, and those companies which are strong on the quality and compliance front will definitely benefit.
Sure, sir. Sir, in that context, now that we are GMP, cleared for the injectables, with respect to the scale-up,
I'm
because...
sorry to interrupt, sir. There is some background noise on the side. Voice is not
Can you
clear.
hear me now? Is it more audible?
It's better.
Sure. So in that context, given that, we have now received the GMP clearance, it is up and running. How do we see the scale-up in this facility and, how much of this facility is visibly booked in terms of orders with our customers? Just wanted to, get some clarity in the runway around.
See, the large customers, they are now setting up the audits at our plant. They do it, once we have this GMP certification in place. So we have dates of many large customers in place, and the audits are scheduled in Q4 of FY'25. There might be more in Q1 of FY'25. So we'll have to, having said that, there is already some order book in place for our existing, production happening and stability, products getting ready for commercialization and out of stability batches. So that progression is happening. To exactly say, when do we really reach peak, or when do we start giving a solid number, it's difficult to say, but we already see a good momentum, very good responses out of the audits that have already happened, and the queries that are coming in for our product portfolio.
Yeah. And we have been also 100% successful so far on each of the products that we have incubated in stability. So that all that product development and stability testing is also going as per our plan. That is the extent of what we can share as of now.
Sure, sir. So one final question before I join back to queue. It's a little operational. The CDMO course probably...
I request you to join back the queue, sir. Please.
Sure. No problem. Thank you.
Thank you. The next question is from the line of Abhishek Singhal from Perpetuity. Please go ahead.
Yeah, thanks for taking the question. Sir, a couple of questions around the injectable facility only. One, have we booked any revenues this quarter? Because our understanding was that you had indicated last quarter it will only start in Q4.
So, very minimal revenue has been there. Very, very minimal, Abhishek ji, already in Q3. But some will also clock in Q4. But this is, nothing to be, to showcase. So, this is very minimal because these are initial batches which have completed 6 months stability and they are now being shipped. Those kind of.
But the entire cost, because now the plant is running full steam, so the entire cost that had to come on the operations side, I mean, above EBITDA and below EBITDA, that is depreciation, that is in the P&L. That's a fair understanding?
That's correct.
That is correct. In fact, thanks for bringing that up, Abhishek ji, because this is where we also wanted to, we have also mentioned in our opening remarks that we have been successful at carrying all this cost and still maintaining our operating margin. So, that's a lot of good work by the team to continue to, maintain despite carrying the cost of injectables.
Cool. That's very helpful. Sir, if I recollect your earlier calls, the communication has been that your CDMO or gross margins are the least. The gross margins in trade generic institutional is better than CDMO. And when injectables come into place, the gross margins of injectables are going to be better. So if I look at the billing of your gross margin wherever versus what your average GMs are currently, is my understanding correct? These are the 3 layers of the gross margin?
That is more or less correct, Abhishek ji. On the injectable front, what will happen in the gross margin is while as an established business, when you look at the injectable dosage form, definitely the gross margins are higher than oral solids, and that's the reason why we also ventured for this. As it emerges, so if we look at it on a very granular or very fine scale, so some batches which we have done stability, manufactured, those will get sold. So initially and getting into the account, there will be some things. But overall, eventually, injectables is definitely a much higher gross margin business than oral solids.
So then the right interpretation is that now with trade generics scaling up to almost like 50 crore a quarter, hopefully Q4 and Q1, your injectable facility revenues start to flow in. And you still, as we stand today, maintain your gross margin / EBITDA margin, or actually EBITDA margin maintenance. So FY'26, from what we report in FY'25 as we look forward, should show some operating margin, that is, I'm talking about EBITDA margin leverage. That's a fair understanding of the way you look at it, situation, right?
Yeah, I mean, to the extent that, because as the injection facility starts to generate revenue and it will first cross over break even and afterwards start to contributing to the margin, so operating leverage will begin to come in the numbers. But see, one of the things that we are trying to do is to be very conscious of our operating costs and improve efficiencies, and those are also initiatives that we are working on. So, in our space, this is something that we always have to be on the top of when we are doing work on that. So, our goal, as Komal has also indicated in previous Concalls, that over 3-4 year period of time, you will definitely see significant change in operating leverage. But as we build the business out, we are not trying to sort of, control costs to manage the numbers. We are, whatever the natural cost of operations is there. Right.
Well, so that makes sense. And so one last question more on the industry side. If I look at your peers, they have pretty much reported quite dismal numbers even this quarter. The sector leader in your space that's listed last quarter had guided to slow down revenues. We saw that in one of your peers this quarter now. And if I look at your CDMO growth, it's, of course, you've had a phenomenal growth in the other two segments, and injectables will help you going forward. The CDMO for at least this quarter was high single digits. So are you seeing some industry pressure, or it's more like a quarterly phenomenon and you're confident about how business is playing out? Some color on that, sir.
So Abhishek, we don't see anything changing, and maybe, the size and scale of our, other peers is different, or the therapies that they focus on is different or whatnot. But, we continue to, do everything the way we have been doing. If you see, in the last 8 quarters, the overall volume growth has been, varying. And we have, through execution, been able to do, the growth that we have. And I believe that there is really, at least we are not able to, comment on what they have said. But so we continue to significantly invest in increasing our business development teams, improving, facing more quality audits, filing more DCGI permissions, increasing our mining with existing customers, adding new customers. All these initiatives that we have on our CDMO vertical, we are continuing to push on them.
Thanks, sir. This is very helpful, and congratulations on super numbers. Thank you.
Thank you.
Thank you. The next question is from the line of Sudarshan Padmanabhan from JM Financials. Please go ahead.
Is my line clear now?
Yes.
Just taking a little, forward from the previous participant on the domestic CDMO side. I mean, I understand last quarter there was a challenge in the volumes across the industry, for various reasons. Just to understand, with respect to our, if you break that growth, 8% growth, in the context, one, is that temporary slowdown that we have seen, is that the reason why, the numbers are slightly lower than expected, or is it also because the API prices, if it has come down and we pass it on, and that is primarily also affecting us. Just wanted to understand, on the volumes and realization, and how do we see the market itself picking up, say, in the next few quarters?
So, I think what I can say is, Mr. Padmanabhan, we've said that in our space, it's better to look at, a longer span than a quarter, because like many variations can happen in terms of, the production and shipping. Some orders get clocked in. Some customers get the production done, but they say that hold the inventory, we want it in the next month. So many things happen in a B2B environment. So I think when you look at on a YTD level, I feel that is more representative of, the things, especially now that we have 9 month numbers. So probably that is a better thing, and it's probably not worth reading too much into the quarterly for vertical wise. That's probably one thing. Maybe Komal, if you want to add something.
Just to also touch upon the API thing that you mentioned. API prices have fallen down, and there has been obviously some effect on conversion. But having said that, there has also been increase in past, and so API prices tend to have some impact because ours is a cost plus model. In the long run, it gets classified for plus as well as minus in API prices. So we have to look at it in the holistic view, as Hitesh was mentioning. So we should look at annual performance for all the verticals is what we prefer. But structurally, we would want to re-emphasize that we do not see a huge change versus what was there, and volume growth has always been either negative or flattish, very around 0, 1, 2% of growth in all the 8 quarters that we are discussing. So we are very sure that the sustainable efforts that we are putting in CDMO vertical are sure to bring good results over a long term.
Sure, ma'am. One final question before I join back the queue is, it's quite heartening to, see that we have taken all the operating costs on the new plant. So, given that the costs are largely in place, would it be a right assumption to basically believe that, incremental sales on a quarter-on-quarter basis with the new plant will have a disruptively higher, flow through to your EBITDA, and of course, given that the depreciation is also already factored in, it should flow to the PAT?
Yeah, for sure, right? That's mathematical. As we add revenue, as revenue comes in, first we'll get to break even, and then it will start to contribute more and more to the operating leverage. Of course, as production also goes further in terms of volume against orders, then some costs may also increase, right? So, but we believe that in the long run, our goal is also that, how can we grow while, so in some sense, the injectable facility was a growth initiative, and we are growing while keeping our margins, in a healthy position. So every time, if like, let's say we had taken a very large, outlay of injectable facility or any other initiative, then it would have had that much of a weigh down on the margin. So in some sense, this is the sort of a win-win model, and we want to continue to maintain it, and I believe over the long run, it will have a very strong, leveraging effect.
Sure. Thanks a lot. I join back.
Thank you. In order to ensure that management is able to address questions from all the participants in the conference, please limit your question to 2 questions per participant. Do you have a follow-up question? We request you to rejoin the queue. The next question is from the line of Sajal Kapoor from Anti-Flegal Thinking. Please go ahead.
Yeah, thanks. Good morning, all. In the CDMO industry, typically the innovation patent is owned by the customer, right, and not the developer or the manufacturer. But in our case, we own 99% of the IP rights to all the products that we develop and manufacture. So what advantage do you get from investing in IP and continuous R&D investments growing at roughly 20% CAGR over the last 5-6 years? I mean, can we sell these products in markets where there is no conflict of interest with our customers? Otherwise, what's the benefit of investing behind IP?
Yeah, that's actually a very good question. And we have, if you've seen our investor deck, in the value chain slide, we have also clarified further the areas of the value chain and how we are operating. But see, if you do not have IP, then what are you selling? You're only selling capacity, right? And so when you're only selling capacity and your customer is providing you the material, you're just converting for his job work, then you cannot have this kind of EBITDA margins, right? Which industry will give this kind of EBITDA margins to only job workers? When you actually have IP, then you have the ability to use that IP and sell the same formulation, maybe with a different color tablet or with different packing material, to multiple customers. Then you're not essentially, you're not selling capacity. You have developed the product and you are able to take it to multiple customers and grow. And that's what we are doing. So I hope I answered.
Yeah, definitely. No, that's exactly what I was thinking and the reason for the question. So yeah, thanks for clarifying that, Hitesh. And the other question perhaps for you, Komal, is on the ROCE slides. I'm looking at slide number 31. So we have got two ROCEs listed there and ROEs as well. So 27% including injectable and 38% excluding injectable, right? So the question is, when we get the negative operating leverage sorted on the injectable, so ramp up will be gradual, FY'26 and then FY'27. Hypothetical scenario, if FY'27 we get rid of all the negative leverage and on the flip side we start getting some positive operating leverage, what ROCE do you expect? Because we currently have 27% taking the pain of injectable.
Right. So just we see improvements in how we look at it at company level at all times. We want to stay around 25 and more. So while injectables is going to be sorted, there will be additional capex coming in for our existing oral solids business, the capacity expansion that we are working on. While plant 3 capex would completely be clocked in within FY'25, but the plant 6 that we are working on for us to be able to reach 1,000 crore for oral solids with the existing, with the facilities, for that the additional capex would again come in. So there would be denominators would keep increasing with this capex and maintenance capex, but still we expect to remain up of 25. So around 27 will increase in a period and might come down, but in long range we want to stay 27, 28 likes of ROC and more.
No, that's helpful, Komal. That's all from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, please limit your questions to 2 questions per participant. Do you have follow-up question? We request you to rejoin the queue. The next question is from the line of Mithil from Factful Capital Investments. Please go ahead.
Congratulations again, Hitesh and Komal, for outperforming the IPM growth margin. A couple of questions from me. For your trade generic segment, the target that we had set of 3x in 4 years has already been achieved about a year earlier than what we had planned. I wanted to understand 2 things about it. One, is it just about better adoption by the market itself, or was there something else to it? and hence, how should we think about it going forward now that the earlier target is already passed?
Thanks, Nitin. So, it is a combination of external as well as internal. So market has been very good, better than our expectations surely for trade generics and institutional. And there have been strong efforts internally as well. This was our focus area. We have always been very clear about it. We expected this to be the highest growing segment. It did better than our expectations. So going forward also, we are very optimistic, positive about trade generics and institutional vertical, and also obviously CDMO and export. But
I think that sometimes I think while various experts may have their own view, the Indian pharma market data that is published does not really capture a large part of the trade generic segment, because it's being sold in the hinterland, and that data is, I believe, sometimes leads to us to say that market is low. But I think, of course, we are selling into the market. We hear that other people are also doing well. A lot of our CDMO customers who are selling into the trade generics market, they're also doing well. You can see very large companies, large pharma companies announcing their jump and foray into the trade generic segment. So certainly, all of this is happening on the base of growth and growth expectations that people have. On the institutional side also, you see this high focus by the government on Jan Aushadhi Kendras. This whole Ayushman Bharat has increased the number of consumers or people who were earlier covered in terms of medical expenses and pharmaceuticals. So all of this is leading to in the long run probably a large part of population of India which was not really getting access to quality drugs, getting that access. And our mantra has been affordable, accessible, and authentic drugs. So this is where we are we are in the middle of this opportunity, and we have to make the most of it.
Great. Again on exports, I think if I'm not wrong, we have hit the highest ever quarterly number in terms of revenue. If you could add color to it in terms of what worked or what is getting traction, it will be very useful. Thanks.
So for exports, we have seen growth versus last year, although maybe highest ever quarter number, thank you for saying that. The overall 9-month number, 22.6, is a combination of 3 good quarters, third being the best, I guess. So about 23% YOY growth for 9 months is not bad. Obviously, not to the extent that we would want to perform in export segment, but exports, because of the lag that stays in our efforts and the results coming in, we hope to deliver much better in future for exports, is what I would like to say, Nitin.
Anything that you want to add in terms of the markets that are getting traction, or how we should think about it over the next 1 or 2 years?
So we are certainly focused on the ROW markets and some semi-regulated markets, plus one South Africa, which is a regulated market. So these are the markets that we are currently operating in. We are adding more partnerships, and we are adding more registrations. Those queues are building up. So I think the kind of opportunity that India has with higher quality standards, and the kind of opportunity especially that we have, having a strong experience of EU GMP facility, shipping product, and now looking to bring that same quality systems and approach to all our markets, it's going to have a very strong future. Even for the injectable, I have spoken in the past that we want eventually to use a significant part of this capacity for exports, where the numbers should be even better. So this is the setup is to bring that exports number to a much larger contributor. How can we do that? That's sort of the focus. And it is very slow because, you just have to file the dossiers and 1.5 years of waiting, and then, the business starts, and then it slowly picks up. So there is a incubation period, but this is the sort of the cream, in terms of how we can build towards. So in the long run, definitely. But 1-2 years, very hard to say what should be there over here.
I have one more question on CapEx, but I'll come back in the queue.
I request you to rejoin the queue for
Yeah. Thanks.
Yeah, thank you so much. Participants are requested to limit the questions to 2 questions per participant. So you have follow-up question, we request you to rejoin the queue. The next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, everyone, and congratulations for a good set of numbers. So my question is on the trade generic side. I think on 9-month basis, we have done extremely well, growing at 40% plus. If you can give some color on, whether this growth is led by institution and generic, how should we look at it in terms of, where the growth is coming from? And more importantly, now we are at a much larger base. So to grow at a decent 25-30% from here, what are we doing, to grow from here? If you can talk a bit about that.
We are actually not providing a split between trade, generic and institutional. Part of it is also because in order to participate into institutional accounts, you need to have 3 years of having sold, manufactured and marketed that product. So, a lot of our trade generics products are the ones that we are able to take into the institutional channel. And and of course, institutional business, as you can imagine, the rate contracts get issued, and then it's somewhat clunky in terms of which a bulk supply happens, and then the next supply takes some time for the next order to come from there. So instead of providing too much detail and then confusing everyone, we decided that let's keep it as one. It is integrated.
Although maybe we can say that there has been good growth in both trade generics and institutional.
Yeah.
Okay. And the second part of the question, what are we doing to grow from a much larger base that we have now?
So the growth strategy doesn't change because we have to nucleate new territories, and we have to expand in the territories that we are already present in.
And keep increasing the product portfolio.
Product portfolio is the second, level. And third is, sort of building upon the strong reputation of Windlas as a quality manufacturer. Because all our channel is seeing our presence not only in our own products, but also in all the manufacturing that we do, whether it is for, someone else or our own selves. So building on this reputation of 23 plus years and expanding the channel, expanding the, geography, expanding the product portfolio. Those are the essential moves there.
Okay, got it. And second question on injectable, in terms of, break-even point, if you can talk at what capacity you think will reach break-even point. And tying in with that, I think we were exploring getting into newer dosage forms. And if we don't find right acquisition candidate, maybe organically also. So how are you thinking about it? Whether once you cross that break-even point, you'll start looking at kind of going organically into newer dosage form. Any thoughts on that?
Yeah. See, on the OpEx side for injectables, as we have clarified in the past, we are a cost plus business. And, talking about dosage form specific OpEx is not competitively wise for us. So we have not disclosed those numbers because it can impact us adversely by revealing our cost basis to our competitors. So to your other question around whether we will look at growing inorganically as our injectable business stabilizes, certainly, and we have always been looking, and of course always with this eye that we have to have a justified addition. It should not be just a balance sheet play. It needs to make strategic sense for us, expand our ability to offer in all three segments products from that plant. So we have been looking at derma as an area. We have been looking at some other dosage forms like protein powders. We have been looking at many others. So far, none of those have been something that we would want to jump on, but that search is on, and
and once injectable stabilizes, if we don't find anything outside, we would surely go for organic.
Creating something, yes.
Okay. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations for the set of numbers.
Can you speak a little louder, please?
Sure, I'll do that. Congratulations for a good set of numbers and thanks for giving me an opportunity. So my first question was on, Komal, will it be possible to highlight, what will be our losses on the injectable plant in the 9 months?
So Ankit, as Hitesh was just mentioning, because our model is a cost-plus model, we would generally not share specific to injectable OPEX because that is probably competitive in that sense. But depreciation number surely, I'm sure you must have looked at the opening remarks. So injectables number is very clear, the increase is coming from.
So let's say, 21-22 crore kind of run rate that we had on the employee cost side in last year on a quarterly basis. So that has touched almost 32 crore in this quarter. So how much of that will be attributable to, let's say, our own, increments plus expansion in our marketing team or some other employee cost increase, and how much will that be because of the injectable plant coming in? If you can just give some highlights on that.
Yeah, so I can segregation, while it's difficult to provide, but I can tell you the reasons for increasing personnel cost, and we might look at it. You are right. There has been increase in our business development teams in all three verticals, so that surely is in place. Increments and increase in production stay as the reasons. Injectables related manpower increase is also one of the reasons. And then, as we had mentioned 2 quarters back, there has been in Uttarakhand, the minimum wage has increased by more than 25%. So that has also brought in increase in our overall personnel cost. So the increase is combination of all these factors, difficult to provide the number against each other.
Sure. Please.
Just one thing that I missed mentioning is also ESOP, which was introduced last year. So last year it was there for I think only 5 months, and this year it is going to be there all 12 months. So that is also another reason.
Sure. And Komal, given how this is my second question, I think, if you can allow me. Yeah. So on the injectable plant, will it be possible for us to break even in next financial year, given how the inquiries are get cleared, the audits as well? So, will it be possible for us to break even at EBITDA level as well as, at the PBT level on the injectable plant next year?
So, we have not given any kind of guidance, right? So, of course, the goal of the entire management is to achieve the break-even milestone as soon as possible. But we have not given any guidance, and we would request you to let us stay in that manner.
But let's say, the kind of inquiries that you're getting in from the customers, plus the audits are cleared. So any qualitatively indication that, how, on the injectable front, how do you see next year for us?
Sir, I just requested to.
No indications.
Okay. Thank you so much.
Thank you. The next question is from the line of Rohan Vora from Envision Capital. Please go ahead.
Hello. So thank you for the opportunity. And sir, congratulations on the numbers. So the first question was on the injectables business. So, when we start getting in business, so would this be, the molecules moving out of our customers' manufacturing facility to our facility, or are we looking to gain market share, as in, there's some other CDMO manufacturing and now the manufacturing moves to us? So what kind of contracts are we expecting here? That was first. Thank you.
So when we were embarking on this project, almost now, in the design phase, almost 3.5 years back, when we did a survey of all the injectable facilities currently available and supplying in the CDMO space, and we had a lot of discussions with our customers also. One of the common factor that came out was that the GMP situation or the compliance level or quality level of many of the facilities was very, very, iffy. And customers were facing a lot of challenges in getting sustainable and reliable supplies for injectables. And this was also due to the fact that a lot of the injectable capex in those old plants also was very, very old. And the guidelines had become very strict over the last 10-15 years. So, only some real, upgrading can happen in injectables. You cannot really completely change the things. So that was one of the reasons we also ventured in, because we felt that we would be a viable alternative to our customers who are getting this manufacturing done, either outside at manufacturers whose plants are very old or no longer compliance friendly, or even to their own plants where they would want to maybe shift towards exports or to other products. So it is an alternate for both. It is a way to our expectation of gaining business in injectables will be driven by both customers outsourcing from us and also shifting their outsourcing from very old and poorly maintained facilities to a brand new facility like us.
Got it, sir. This is really helpful. And the second question was not to nitpick, but what we see is, in the CDMO vertical, we are at that 135, 136 crore kind of a run rate for the last 3-4 quarters. And I understand that there has been erosion in the API prices. However, is there anything else, that is also impacting that particular vertical? So that was a question. Yes.
In fact, as we have been saying, we should not look at any quarter number, because there is always some impact coming in from earlier quarter and some going to the next quarter. So it's good to look at CDMO, trade generics, institutional, as well as exports numbers on an annual basis, is what we like to say. While obviously every quarter we give the numbers and YOY, but it's not a good idea to focus on a quarter number. As we mentioned earlier, there is no strategic, specific change that we are seeing. We continue to stay very positive on CDMO vertical as well, like all the other verticals.
Got it. Thank you. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Pawan Kumar from Ratnatraya Capital. Please go ahead.
Hi. So I wanted to understand what are the targets in terms of capacity utilization for injectables next year, And also, by what time do we think we can get it to be, we can start exports from that facility? Are there any other steps post GMP accreditation that we need to undergo to get this facility to export, or how are we looking at it overall?
So, like our existing oral solids and oral liquids business, we continue to not give any guidance in terms of revenue, capacity utilization, etc. But as we mentioned, GMP certificate is in place. The customer audits are happening as we speak. We are getting queries, so specific number difficult to mention, number one. And about exports, while we have started working on it and there are a lot of initiatives taken internally, but it would take a lot of time. So probably that is why we haven't even given any specific update in terms of injectable exports, because that will take a lot of time and would need everyone to be extremely patient.
What basically export products are developed to the specifications of the product in those markets. So British Pharmacopoeia, US Pharmacopoeia, and so it requires separate stability batches. And then after that stability batches are done, you compile the dossier and file in the country. That takes about 1.5 to 2 years of review and approval time.
And meanwhile, plant approval also has to happen.
Yes, and then the inspection gets triggered, which they come and do. So all these steps make this but of course you get the very high margins also in those markets because they literally have no domestic production. So this is the reason why export is a little bit fag-ended. And however, we have already, we have done our product selections. We are working on, in taking all the steps that are required to, expedite wherever we can. We have had our conversations with our export customers. All of that is ongoing.
Can you at least give us an indication of when maybe at an EBITDA level the facility, injectable facilities breaks even? And also, if injectables, basically exports is going to take time, my current understanding would be the ROC on injectable facility is very low. So, is the first, what are we going to see first? Is the doubling of the capacity in injectables or the exports?
No, it will be a very good outcome, right? If we have to double the capacity in injectables because there are so many orders that we cannot supply, then it's a very good outcome. Now, why would we try to either place either one of them in front? They're parallel efforts, they're parallel streams, right? Now, as we file in various markets, some permissions will come, some markets will have a different timing compared to others. And while the facility is continually being used for India, even in India business, the gross margin for injectable will be very high than gross margin for oral solids. So from a financial perspective, this is all, it's a win-win, right? As long as we can, ensure that the ramp-up is very fast, it will bring very good results. And that's what our focus is. We are simply just not giving the guidance to you on that, right? That's all. But all the activities are being done.
Got it, Hitesh. Thanks.
Thank you. The next question is from the line of Nitin Gandhi from Inocus Advisors. Please go ahead.
Thanks for taking my question. Can you give breakup of investment in financial assets?
Sorry, can you please repeat the question?
Can you give breakup of investment under financial assets?
Sure, 1 second.
So, So we have money lying in mutual funds, upwards of 200 crores. There is some mutual funds includes liquid funds, debt funds. There is also fixed deposits of about 15-16 crores, some money lying in cash in bank, and minus CC utilization that keeps happening and keeps changing. So that's broadly.
Okay. Major MF and FT breakup I got. Thanks. And second is, what is the total investment in injectables?
Investment in injectables about 75 crores.
Then depreciation, which you are saying, it is almost 13 crore excess. Is it? Can you just reconcile that for me?
So we follow WDV method, which tends to have higher, heavy. Of course, the breakup would be plant and machinery, building, etc., etc. So I'm not going.
WDV is 30%.
Yeah, I think in a previous Concall we had also mentioned some WDV, I think 17%.
And it changes asset to asset, so we don't give a percent as such, but yeah.
I can take it offline, I think that's okay. 35 crore is a major investment and 30 crore you return on WDV basis. I'll take the rate separately. And what's the target asset turnover? That's the last corollary of that question.
Asset turnover, it probably would be a good idea to look at the year end.
No, I'm saying at optimal level, not 1 year or 2 years. So what's the expected asset turnover?
You're asking for injectable.
Injectable asset turnover, typically, if you see most pure injectable companies, it will be between the range of 1.2, depending on, of course, if you start exports, then it can be a little bit higher. If it is mostly domestic, then at least, 1.1, 1.2.
Okay. Thank you very much.
Thank you. Ladies and gentlemen, please limit a question to one question per participant. Do you have follow-up question? We request you to rejoin the queue. The next question is from the line of Abhishek Singhal from Perpetuity. Please go ahead.
Sir, I just had a follow-up question to the previous participant. You mentioned the asset turn of around 1.2, 1.3 on the injectable side. Now, if I understand correctly in our past interactions, you mentioned that given it was a greenfield capacity, civil structure and all was put in place, the first phase came out to be somewhere around 75 crores. Now, in a scenario where you have to double your capacity, it would be like just adding one more floor, and we've seen that facility. In that scenario, doubling your capacity, the incremental would just be plant and machinery, which I think would not be more than 25 crores at the max. So technically, if you're looking at an optimal utilization of your injectable capacity over the longer term, let's say 3 years out, then 70 plus 25 would mean like 100 crores kind of an investment. And if you're talking about 1.2 on the primary stuff, with the doubling of capacity would mean like more 2.5 times the capacity. So where is my maths wrong if I take more like a 3-4 year view on the injectable asset that you have put?
So Abhishek, you see, there are a lot of assumptions in that, calculation. So for example, like when you say, okay, double the capacity, right? But is that the right thing that we would do? Because, we would add, within injectables, there are a lot of other variant dosage forms, right? If we go more for lyophilization or more for, pre-filled syringes or some other areas where we see a lot of, there might be better opportunities in terms of the markets that we are chasing for exports, I'm talking about. So all those things will change. But so my sense that what I was talking about is primarily the question, the previous, query was about what is a typical asset turn for a, domestic CDMO injectable company. That's where I said it was about 1.1 to 1.2. We are, going to start like that. But as we add capacity and as we add markets and we go towards exports, these things will very much change. So, I was giving more sort of around what the domestic numbers are typically.
Got it, sir. Thank you very much. Makes sense.
Thank you. The next question is from the line of Disha from Sapphire Capital. Please go ahead.
Firstly, congratulations on a great set of numbers, sir. So as you said before, like the injectables facility, only the cost has been factored in. Revenue will start flowing from like next year. What will be your guidance for revenues in FY'25 and FY'26? And also, what margins will you be expecting?
Well, thank you for the question. So thank you for the question. But as I mentioned, we are not giving the guidance. So request that we stay like that. I'm sorry. There was a second part to your question. What was that?
I was just expecting, sir, like the EBITDA margins. What range, like, will you be expecting that?
No, again, it's a question of guidance. So
Yeah. All right.
Thank you. The next question is from the line of Paris Cheda from Purple One Vortex Ventures. Please go ahead.
Yeah, most of my queries have been answered. So I just got only one thing to ask for is there are two things. Basically, what is the current capacity utilization across the 4 plants that we stand today operationally? That's number one. And secondly, on the inorganic growth front, we've been sort of at least somehow been able to beat the industry growth and do well. So what sort of factors do you face as of now in terms of acquiring or leasing in a facility and grow? Because eventually when the industry grows, we'll have that leverage additionally. I've been sort of tracking. We've been on the lookout, but it's still not happened. So these are the two questions that I have for now.
Yeah. So with respect to the inorganic, let me answer that first. Several quarters ago, we were very close to identifying something. We even incurred some diligence costs, but then we found out some adverse issues and this declined. There are a lot of investment bankers whom we have given a very good and a very clear brief about what we are looking for, and from time to time, several proposals also come. For us, the most important thing right now is that we have one of the strongest balance sheets. We have a strong growth momentum, and we are being very choosy on the inorganic side, because aside from having the opportunity, it is also, we don't want to be in a situation where there will be hidden or unknown issues that, end up taking too much management time. So we are looking for good assets, and that's sort of been, the reason why we have been so far not been able to close on anything. And I again am not setting a timeline that we have to do a deal by this date, right? It has to be dependent on what the opportunity is and whether it makes sense. So that's on the inorganic side. Your other question was?
On the capacity.
On the capacity side. So, yeah, on the capacity side, in Plant 2 extension, we have expanded, which has come online, this quarter, now in Q4. And so I don't think that much would have changed in the Plant 1, 2, 3, and 4, maybe a few percentage points up, but more or less, adding the capacity here in Plant 2 extension. And then, so although we give the utilization numbers on year end, right? So,
so we have sufficient capacity for our oral solids and oral liquid business to reach or cross about 800 crores. This is a side of injectables. So that much capacity with Plant 2 expansion is in place now.
Okay, so there is still room for further growth in FY'26.
I just request you to return the queue, sir.
Yes.
Yeah, thank you. The next question from the line of Neelam Punjabi from Perpetual. Please go ahead.
Yeah, thanks for the opportunity and congratulations on some great set of numbers. My question is on the capacity. So you mentioned that we have investments in place with the plant 2 expansion and injectables for taking the overall top line to 1,000 crores, right? And we've already hit the 200 crores as an annual 800 crore run rate on a quarterly basis. So what is the planned capex going forward to take our revenue beyond 1,000 crores?
So Neelam, actually what we had spoken about earlier, a small correction in what you just said, is that along with plant 6, which is the brownfield project that we acquired last quarter, we will build that out, and then by finishing that we will reach 1,000 crores. And in terms of our strategy for growth, our model is slightly different from others. We try to do a 2 to 3 year window of expansion rather than 5 to 6 year window of expansion.
Understood, sir. But if you can just tell me what's the incremental capex that we are planning over the next couple of years?
I think that, one upcoming capex will be primarily for plant 6 bringing up, which is the oral solids expansion. And we are in the layout and machinery identification selection process. So I request that, I be allowed to comment on this query by end of March call.
Sure. No worries. And just lastly, if you can give me a couple of bookkeeping questions. What's the net cash as of December and what is our working capital days?
So again, Neelam, since, those are not part of LR, we are not, disclosing those numbers. But we are still within range of what we have been typically.
Got it. Thanks a lot.
Thank you. As that was the last question for today, on behalf of Windlas Biotech Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.
Thank you.